This morning, little changed after a correction, or not correction, but ultimately a decline yesterday. The oil market's recovery since Omicron collapse, it seems it may have lost a little bit of its mojo. Its recovery is looking uncertain. It's also an opportunity to reflect on the year past, as we have our regular commentators for the last time this year, before we take a 1-1 break on the season to go celebrate a little bit, take a time out and reflect on why Arsenal just are not going to get in the top four. As it's a bit of a false dawn. I know it's a bit like the oil price, a dead cat bounce, but at least one can get excited for a brief period. And we're also delighted to welcome a new commentator to the table this morning, Reem Shahsadeen. Let's start off, though, with Matt Stanley, Director of Star Fuels. Matt, we had the Saudi oil minister, the king of OPEC, out overnight, barking at short sellers and scaring about a possible collapse of 30% of world oil supply because of the lack of investment. Your thoughts on where the market's at this Tuesday morning?
Yeah, well, look, you've just made me ouch like hell, Sean, about my Champions League prospects. So oil traders across the world are the same.
You know, dream is good. Dream is good.
Yeah, hope is great, but it's not a strategy, right? You told me that.
Exactly.
On that note, let's talk about the oil market, shall we? No, yes. Look, anyone who's been in the market this year, or for the last 5 years, really, it's really been leveraged off expectation as opposed to prompt realities. OPEC yesterday were bullish, as they always are, as they have to be. There's some realism they put around Omicron and what it means. But look, in essence, Sean, the variant is a cause for concern. It's something we will have to live with. But it is in the EU. I mean, I've got some mates who went back at the weekend and they've tested positive in London, and things are not looking great there. It's pretty grim. The Grinch is out in full force. We won't get back to the lockdowns, I hope. I certainly would have said that with a lot more confidence 2 weeks ago. But Boris, well, I mean, he's on a quiz night tonight, so no one knows what he's going to do. But when he does come back to the office, or number 10, or greets his new daughter, or whatever he's going to do, I'm not so sure he's as confident about no lockdowns as he was 2 weeks ago. And the situation is so fluid, and that's something that has really been the key word of 2021 is keeping up with how fluid this situation is and its effect on oil demand. Look, it's recovered. Year 2021 has been the year of recovery. We dropped to 90 million barrels of demand last year. I think we're at about 98 now. We're not back to pre-COVID levels yet. We're not far off. So OPEC have kicked that demand can down the road until Q1. I think they'll address it then. I think January could be pretty grim. But look, at the moment, reality is being ignored, and it's all about expectation and hope.
Let's welcome Mark Otswald, Chief Economist and Global Strategist at ADM Investor Services International, sitting in London. We have oil, Brent at least, trading this morning at 74.37, under 75. Little change today, but the recovery we've seen since the big drop, Mark, is it a rebound? Is it a recovery? What do you think the momentum has been, and now what is petering out?
Well, I think everything at the moment is testament to the fact that we still have this 20 trillion of extra central bank QE around. And we have a lot of the paper money involved in commodity markets, that's oil as well as everything else, basically being the tail that wags the dog of most markets and creating enormous volatility. So some of I think the fall was exaggerated. The bounce has been exaggerated. I keep on hearing from physical oil traders that I don't really understand what's going on here, because in terms of actual flow of physical trade, there isn't really much change going on. And I think that really tells us a lot, because it is the speculative element. And at this time of the year, it is, it's very, very thin. It's thin in any case. Most markets don't actually have the sort of depth that we used to expect. simply because of regulation post GFC, and even more so now because this is a very, very fickle environment, as Matt was just saying. So to my way of thinking, we are probably, you're having had the crash bang wallop and having had the sharp rally, we're probably going to see some sort of stabilization. And the fact remains, and I do agree with the Saudi oil minister, we have had a chronic lack of investment, and the pressure to not invest in hydrocarbons is going to create a massive shortage going forward. And it's a legacy as much as that sort of pressure. So to my way of thinking, yeah, I don't think we're going to have the sort of hit from Omicron, despite what's going on in countries like the UK and Germany. Eventually we'll come out the other side of this and work things out. Hopefully this week we'll start actually getting some proper research, medical research on this in terms of what its contagion effect is. Not only
well, there's certainly big words being used in recent days, none other than the British Prime Minister. I think he used tsunami or some big word for what this Omicron could build up to after the holiday season. Let's welcome Reem Shamsuddin, senior correspondent at Zawiya Arabic and also a longtime OPEC correspondent with Reuters. Reem, welcome to the table. No better person to have on to comment on all things Saudi Arabia at this moment. And maybe it's very opportune that we end the year with a very pronounced comment and strong words by Prince Abdulaziz, as in many ways he's been the man of the year in the context of the oil industry, certainly with the biggest influence. Your thoughts on OPEC, where OPEC Plus ends the year, Reem, and the decision recently to increase supply, continue to increase supply into what is an uncertain outlook?
Thank you, Sean. Thank you. Very happy to be with you. Actually, the year has been very volatile, and I believe that OPEC Plus, what it did in December 2, as we've all seen, was the right decision to take. And going forward, I believe that based on OPEC report yesterday, they are optimistic about next year, even though the market has been very volatile. And for sure, the signs that we have to look for next year will be the surplus or oversupply in the market that is predicted to happen, and the policy that they're trying to adopt. And basically, it's unlikely that OPEC will probably meet before January 4, as expected. So these are the main, and the stock release of the countries that planned to release stocks. So basically, these are the signs that we have to look for. But in terms of like where OPEC Plus is gonna have to change course, it's unlikely at this point because of the many changing factors that are still happening, and the Omicron on effect on sentiment on sentiment and the oil market. So this is how I read.
And Reem, when you look at obviously the Saudi oil minister speaking yesterday, it's always entertaining in different ways, his language and his, but he typically speaks quite seriously as well. And his sort of warning of 30% collapse in oil production over what is less than a decade is quite dramatic. But my question to you, Reem, is about the geopolitics of this moment with OPEC plus Saudi and how they end their year with the relationship with the US. It seemed that there was an uncertain moment there where the US was calling for more oil. OPEC Plus could have chosen to pause. They didn't, so they avoided perhaps a confrontation with the US. But I'm wondering your perception, insights as to where the Saudi-US relationship ends the year.
I think from what I read is that what happened, like with the OPEC Plus decision, I think the U.S. saw that it was a gesture of goodwill, and and it was like more or less it was a diplomatic move as at the same time that people saw Saudis taking. I believe that the tension, based on what I read, is has been lessened down, and of course with the Saudi energy minister has been talking like vocally about what has been going on with regards to the energy transition. Because the investments have gone down dramatically. I mean, we've seen that investments recovered a little bit this year from last year, but it's still not to the level that the industry has to be at. And has been quite realistic about what
the consequences of that are
consequences of what this could have on prices.
And certainly it is in some ways also a direct criticism or certainly challenge to the Biden administration's green agenda. Clearly that doesn't go amiss. Matt, the point Reem makes there, which I think is worth noting, that OPEC did correct or upgrade their demand expectation for the first quarter yesterday. It was recently the other way. They were expecting a bit of a deluge. Now they're saying some tightening because Omicron might actually push the demand recovery out a few months. Your thoughts on that analysis that they're putting forward for the first quarter?
Yeah, I thought Reem made some excellent points there. So welcome, Reem. I thought that was really interesting. Look, the demand can, as I said to start, was being kicked down the road by OPEC. That's all they can do. That's really what's in their power. And I think that Prince Abdulaziz yesterday warned the market. And what that would do, that would just add another floor and another support floor to prices that $70 a barrel will not be accepted by OPEC. And that the court is still in session, literally, and they will do what they have to, when they have to, however they have to do it. So I think that was a warning across the bows. And as Mark said, who are the investors in the market? You know, if we're relatively small volumes this morning, 14,000 lots, not much at all in the grand scheme of things. I know it's holiday season. Most people aren't awake or not home yet. And look, the market's been down $1 and up $1. So volatility is certainly still there.
Do you think there's an appetite, Matt, to short this market? I mean, clearly the collapse of 2 weeks ago would signal some recalibration in the structure of the market.
Yeah, well, that's the key thing, Sean. I don't think it's an outright flat price play. I don't think the markets are interested in that. And you've got to look at how structure has come off. It was only 3 or 4 weeks ago that June Brent was trading at about $3 backwardated, and now it's struggling to keep above 10 cents. Now that implies that the market has great concern about prompt demand, and nowhere has that been more prevalent. It's supported wise in the front Brent structure, you know, the front versus M1 versus M2. And that concerns me greatly, you know, seeing that support come away from the market. And with people generally selling spreads, flat price will come off. I don't think there's some outright selling, because I think that would be a little naive even for a speculator to do that, because ultimately that support is there from Prince Abdulaziz. But reality does have to hit home, and whether it's Omicron or Delta, whatever variant it may be. And Chris Whitty, the UK chief scientist, said 6 months ago, I will be standing up here talking to you about the latest variant of COVID. It's how each government has to deal with it. But as Reem said, it's sentiment. Market sentiment has weakened dramatically over the last 4 to 6 weeks. And that's been reflected in Brent structure. And that's the one thing that I'm really keeping my eye on to the end of the year, to see where Q1 starts and where that structure is.
Mark, we've talked about the impact of OPEC Plus on the market, obviously Omicron. What about the Fed and tightening? That's a big story this week. We're expecting some guidance. Your thoughts on the outlook for that and how it will sort of impact the market direction going forward, where it's a downward or upward move?
Well, we've got all the central bank meetings this week, that deluge, but the Fed's obviously the most important. They're likely to double the pace of their taper. So instead of ending in June, we're going to end in March. And thereafter, they can start to think about tightening. I think for markets, but be it energy markets or any other, they're still for the moment saying, well, we're still getting money pumped in. And so buy the dip very much is our mentality. So I think that holds in place, but there is an element of complacency. There is a sort of almost like a Pavlov's dog learned reaction that every dip is bought in pretty much every market. The size of the dip really depends on how thin the markets are. So at the moment, you could get some very large dips, which are then met with very violent up moves, simply because there isn't a lot of liquidity. I think the central banks, the story about central banks gradually responding to this inflationary pressure that we have, which is certainly not transitory, is something the markets really haven't taken on board. And it doesn't matter which sort of market we're talking about. And central banks, the real danger is at some stage, some of the major central banks go down the route of what we're seeing in emerging markets, where you're getting 100, 125 basis point rate hikes in countries in Latin America, in Russia, and that suddenly starts to upset the risk sentiment, and it is this risk appetite which is pretty much crucial at the moment.
Of the major central banks, Mark, we've heard, which do you think? We've had noise that the UK will be the first to move on that. Your thoughts?
The UK probably will be, though the Bank of England now is a beyond unreliable boyfriend. It's basically just saying, well, we'll see how the wind blows, basically. That's their guidance. I think they probably will be first, but they're not going this week, particularly because of the weak GDP numbers we had last week. They probably will go in February, but it's going to be a very slow trajectory. And I think the key point in terms of interest rates is, markets are pricing the end point, the final end point for US rate hikes at 1.5%. If that's the end point, then people need to think about the fact that safe assets basically still are going to be unattractive. And so you will still have this buy the dip mentality, and that's absolutely critical. And that's essentially what's underpinning markets. My concern is, as we roll back the fiscal support, as we roll back the central bank liquidity, suddenly we're going to get to a situation where some of the things which we felt weren't a problem, like credit defaults, because basically bankruptcy is effectively being banned by most governments, are going to come and hit us back in the face quite hard, and realize that actually the world economy isn't in such a great stage, particularly as it's going to be transitioning. The post-COVID economy is not going to look like the pre-COVID one. How it looks, no one really knows.
Reem, the other factor sort of on the outskirts of impacting the oil markets are the Vienna talks, with the nuclear talks with Iran, which do seem to be getting a lot of very negative sentiment reporting out of there. I don't know if the journalists are just getting bored and they want to go home for Christmas, but it does feel like, there's not a lot moving. Your thoughts on that, the outlook for that and its importance?
Yes. Well, actually, it looks like it's unlikely that a deal will come out from the Vienna talks, and it would have been important for the Iranians wanted to push for the talks to be fruitful, because they wanted to sell more oil. But from what we read and what we see, it's unlikely to happen. The deal is unlikely to happen. So
what is the consequence of that then? I mean, a no deal avenue, the pathway, the dominoes that start falling from that seem to be quite ominous. Your thoughts on that?
The consequences are that basically they wanted the deal to happen, but it probably it didn't. The talks didn't go the way they wanted or expected to go, and more pressure on the market. It's like more pressure from on Iranian crude, not on the Iranians not being able to raise the production the way they wanted because they can't sell it because of the sanctions.
On the point of the consequence of no deal, which would then leave the Iranian nuclear program accelerating its journey, geopolitically, that's very problematic for the region, Israel, Saudi. Where do you think that goes from a point of view of regional tension?
I don't think that like from what I see from all the recent visits that have been happening in the region, I don't see that the region wants stability. This is number one. So they don't want to escalate things with Iran. That's how I see it, and that's how I read it. So I
wonder if that's what's causing the Iranian talks in Vienna not to be progressing, because the Iranians might be saying, well, all the talking we're doing in the Gulf is the most important part, so we don't necessarily have to give up a lot here in Vienna. I don't know how these all stitch together, but it's certainly, when you look regionally, you'd be quite optimistic that a deal could be done, because there's all of this alignment appearing, or at least efforts to find alignment. And then all the reporting out of Vienna is, we're so far from a deal, we're going home for Christmas. So it's kind of two sort of different images of the one story. So certainly one to keep an eye on. Let's go to the survey.
Sean, can I just add to that?
Please,
Iranian thing?
Yeah.
I think yesterday was quite a seismic shift in how Iran are going to price their crude oil exports. So they're going to move from a Brent weighted average, which is fairly illiquid and difficult to hedge. It's quite a technical point if you're not in the crude oil trading market. So excuse me for being a geek.
Yeah, no, it's important. We have it in the digest today.
They're going to move to just the Brent futures settlement, and what that does is that really opens up liquidity for people to hedge. You don't have to be in the market all day, every day. And I just think it's a move from the Iranians to make their crude a little bit more accessible to people that may not see it. And there may be conduits and ways that they may be looking at, and pricing is certainly one of them. And if it can make it more interesting to a random refiner in the Med, because he couldn't hedge on the current pricing mechanisms, I think that just goes to show you that they're looking to mitigate ways, not just through talks in Vienna, but future partnerships. So I think that's an important move from them yesterday.
But is it not also the potential preparation for that? If you were expecting the Iranian talks in Vienna, because it seems like the talks in Vienna are still the gateway to increasing exports, right? And without that, it's problematic.
Yeah, but I just think it signals to the market that they're ready, and if talks don't go as quickly as they hope, then there perhaps other conduits. So I think that's why it was important.
Other conduits, quote unquote. None of our friends would be involved in anything like that. What are you talking about, Matt Stanley? Let's get the survey question in and see where the room is at on this. What has most impact on keeping Brent from regaining its $80 mojo? And there's no all of the above. What has I was going to say,
where's 5? All of the above.
Yeah, that's on the Christmas table. 1, Omicron still loitering. 2, inflation, Fed tightening. China wobble. The whole China story seems to be a weakness in the oil market complex, or OPEC plus adding more supply. What has the most impact on keeping Brent from regaining its $80 mojo? We thought we were going to soar up there. It was looking very likely earlier in the week at $76 or wherever it got to. Maybe it'll still regain its mojo. But which of these do you think is the obstacle? And we will move around the table and get a sense of where the year ahead is going, Mark. We've got to wrap up here, regardless of where oil prices go in the next few days. We're still in a very robust $70+ Brent average for 2021. Any oil producer on the planet in January would have bit your hand off for that. Big rise. And of course, it is the average across the year that makes the most relevance to the oil producers, maybe not to day traders and so forth, but certainly for the big actors, that's the big number. What's your sense looking ahead 2022? What are the big themes to be watching out for?
I think the big themes are how do governments gradually normalize economies and how we adjust to living with COVID. We are just going to have to learn to live with it. And that's been the process that we've been going through this year, and we'll accelerate it. I think the big themes are the fiscal withdrawal and the monetary policy withdrawal for next year. Because, okay, this year it's been mostly in emerging markets. Next year, we are going to see most central banks step back and most governments actually not supplying as much, providing as much fiscal support for these economies unless there is a dramatic turn in terms of a new variant which forces a lockdown. I think that, it would have to be really, really bad, in terms of it would be really virulent and creating a lot of fatalities. Otherwise, they'll all try and avoid it. And we've got a huge backlog. So the question then becomes the supply chain bottlenecks that we've got, which are a lot of them which are structural because of lack of investment across the world. It's not just Europe, it's South America, it's Asia. Even China's got its infrastructure investment wrong. And so the big themes are, will China actually manage this property debacle that they've got on their hands? Will the central banks above all, the US and the UK, because both Eurozone and Japan have structural deflationary pressures from the lack of labor market, their flexibility. So it's really about the Fed and, to a certain extent, the Bank of England, even though it has a bit of a side role, and whether they start to tighten quite significantly in response. And at some point, I do wonder whether markets, and this applies to asset markets as well as to physical commodity markets, suddenly take fright if they suddenly see central banks pressing the panic button. And the central bank's role here is going to be absolutely critical, because there is a danger that some of them actually lose the plot, so to speak, and that would definitely upset everything.
Mark, just quickly, could we start the new year with a Russian invasion of Ukraine?
In the middle of winter, no. I think basically what Mr. Putin's trying to do at the moment is distract from the appalling management of the COVID situation in Russia, which no one seems to want to talk about.
Okay. A distraction story. Matt Stanley, your thoughts, outlook 2022, the big themes.
I thought your poll question today was interesting because, as Mark said earlier, it's
as compared to all the other days where it's complete.
Well,
rubbish.
yeah, they've been rubbish, but this one was all right today. No,
this is a good way to finish. up the batting average.
Well, what are you going to do better next year? No, it was good because it's the speculators compared to the physical traders. I think the biggest headwinds that the physical oil market faces is how China deal with this fallout and its repercussions within the wider economic environment. It seems to be buried news. Mike Muller, you had on the other week, said that the incremental Chinese buyer is not there at the moment to pick up those crude cargoes. We're going to see surplus of cargoes in the, from the Atlantic Basin crude. So that's a concern. I think that's what's really the catalyst for structure coming off, because look, the more oil there is on the water, the more you need to carry in the market to cover some of that cost. It's not there for free. So number three, I think, is what the physical, but Omicron is there. As Reem said, the sentiment has shifted, and it's, whether it's, like I said, it's earlier on, it's Alpha, it's Delta, it's Charlie, or whoever it is going to be. COVID is going to rear its ugly head, and it's how each government gets on with it. 2022, I think, has to be the year of realities. Jet fuel demand, where does that come? When does that come back? If it does come back, are people going to be more willing to travel? And if that's forever going to be dampened because of COVID regulations or just a general change in ESG requirements, whatever it might be, does road transportation pick up that slack from that demand dropping off? So it has to be the year of, okay, we forecast this, it didn't come in. as we forecast, and markets need to reflect that reality more. But look, up the poll question, Sean, will be fine.
Let's get the survey result and give Reem the last word this morning. Omicron loitering by a long way. Wow, okay. Reem, your thoughts looking to the year ahead, what might be the big themes to watch out for vis-a-vis, I suppose, ultimately in relevance to the energy markets?
Yes, Sean. Well, I think would be interesting to look out for how the supply is gonna be in 2022 due to the underinvestment that we've talked about. And we're going to look at also the energy transition and the pace of the energy transition, and how are oil producers going to adapt to this new reality with the investment and decarbonization, and the pressure from investors as well to turn to clean energy. As well, we have to look at the recovery, the pace of the recovery of the global economy. Because as long as the global economy is not recovered, there will be always pressure on energy markets as well. So these are the three, and of course some political developments. For example, we have the Libya elections. If they happen or not, we have to look to watch out for this, because it's important as well for Libya production and exports of oil. So this is these are my thoughts for next year.
We thank you for your thoughts for next year, and we welcome you back in the new year. It'd be great to have you as part of our regular voices, because I really enjoyed what you had to say today. My little penny's worth on this conversation year ahead, I think, I know there's all of the things you guys have mentioned, and just a layer on top is the politicization, is that a word? Politicking around inflation. Inflation is going to become a very loud campaign word in the US next year. It's going to be barked from the rooftops, and it's going to really become not only a problem because of the cost of everything going up, but it's going to become a real political problem. And how politics manage that, how politicians manage that, how the intersection of politicians and central banks come together or don't around that. I think these are all, I mean, of the many things, that clearly is one that I'll be watching out for. It gives great narratives to follow, but also great consequences, because I think what Mark is indicating, and I think maybe this speaks to it a little bit, is the potential of the acceleration of the tightening having to happen quicker than people maybe expect. We're already seeing in a short window of time the tapering window being halved, right? Not just, okay, we'll do it over 10 months, we'll do it over 9. No, it's gone from whatever 10 months to 5 or whatever, it's been halved basically overnight. And that type of thing could suddenly go from no rate increases to 2 or 3 in a year, and wow. So I think that's really a big shock factor potential in the new year for all of us, as well as all the things that you guys have mentioned. But Mark, thank you so much. Really appreciate your participation this year. Great insights as always. And Matt Stanley, thank you so much. There'll be hope for Arsenal. There's no doubt it's coming home again, I'm sure. Reem, as always, thank you for joining us. Really great. I've always enjoyed your work from afar and really appreciate you participating with us. So to all of you, Merry Christmas, and we'll catch up tomorrow, or I think 2 more shows till the end of the week, and then we'll wrap for the season. So join us 10:30 every morning. All the best.
Merry Christmas. Thank you.
Merry Christmas, everybody.
Thank you.
Merry Christmas.